recording started here. All right. And then we could probably give a few minutes if more people want to funnel in, but we already got a few here. I know Big Mac mentioned he's in class right now, but one of the things I did want to go over, he showed me a portfolio with some ETFs that he's looking at, and I kind of wanted to compare them to the S&P or compare them overall, just see if they're good choices. Because one of the main issues is with EU investors, I don't know what ETFs would be considered equivalent for certain funds. So for example, I do know that VOO is typically VUAG overseas in Europe. That's pretty solid fund. I know it's the accumulation of the S&P 500, but other than that, like for stuff like QQQ, I'm more recently learning that it's EQQQ for a lot of foreign investors, and there's other funds though that he was asking about, like VUG, the growth large cap growth index that I invest in. What an equivalent to that would be. And then same with VGT, which is the tech sector, so large cap tech stocks, and kind of what the equivalent to that is. I will pull up briefly what he sent me, and we'll just take a look at Yahoo Finance to kind of see if they're good funds or not, and if they kind of match what they're supposed to be matching, as well as like stuff like expense ratio. Couldn't think of the term for a second, which isn't involved on some things like VOO. I don't even know if it shows it here. I don't typically use Yahoo Finance. There it is. 0.3, which is realistically or 0.03, which is realistically like one of the lowest expense ratios there is for the S&P. The only one that's going to beat that is FXAIX, which is what I invest in personally, at least in my doesn't have it here. My expense ratio. There it is. So 0.01. Technically it is 0.015, but about half of what VOO is. The only difference here is that it is a mutual fund compared to an exchange traded fund or an ETF, which means that it's less tax efficient. So you are going to end up paying more in taxes, and that expense ratio ends up being higher anyways, due to the person who runs the fund. Fidelity owns the fund. The person who owns it, if they're selling and buying shares of things and moving capital around, the investor is the one who actually takes on that tax burden in a mutual fund compared to an ETF. Versus, ETFs are typically 3 letters, sometimes 4. So like VOO, VGT, VUG, these are all ETFs, exchange traded funds. Versus, when they have 5 letters, you're looking at a mutual fund, which means that it is less tax efficient than an exchange traded fund. So we're going to take a look at some of what he mentioned today. So one of them being VUAG. This is obviously, the one I already mentioned. I've done my research into this one. I have no idea what this is, by the way. I just don't know if it's because it's a foreign fund. It doesn't let me pull up the basic one here, but it's the same thing. I just don't know what the .xc is here.
Have you heard of VUAA?
VUAA, is that, let's see if it's, okay, so this is the accumulation ETF, okay, so Vanguard S&P accumulation ETF. Year to date, these track the same things, it looks like, so I wonder what the difference here between
that's the one I invested.
I wonder what the difference is between AG and AA. Curious. So this one mentions it's the US dollar, so maybe it's I'm not quite sure. All I know is VUAG or VUAA are both the ones that I've commonly heard. There's another one, VUGA, I believe, or VUSA. That's VUSA. So that's also S&P 500. A lot of different funds like this are going to track the S&P 500. Just depends on the exchange that they're on and stuff. So it's not the biggest deal. VUGA is even another one. Oh, it's a private one though. But yeah, so VUAG I think is a great pick for what he had. The accumulation is actually very, very important too. Utilizing the accumulated fund, because what people don't know is when it comes to long-term returns with an investment, especially those that are holding something towards retirement, about 70% of the gains, I don't know the time period, but about 70% of the gains are accounted for by accumulating dividends. If you do not accumulate dividends, you're going to have 70% less value in your account over the course of, I want to say 30 years. I don't want to butcher it. But essentially speaking, if you were to have $1 million investment portfolio by reaccumulating dividends and reinvesting them into the fund, without doing that, you would be sitting at about 300K as opposed to 1 million, which is obviously enormously significant. So that is one thing for those of you watching it that have your investment accounts, really, really make sure that you're reinvesting dividends. It's super, super important. Or you might end up getting to retirement and then, yeah, I believe you're right, Big Mac, the specific exchange that they're with, which I honestly, it shouldn't make a difference as long as it's something that your brokerage offers. Because yeah, that's the biggest issue is I don't quite know the euro based funds yet. Like that's something that I do want to learn a little bit better, like the equivalent funds. I'm a huge fan of Vanguard. I have all Vanguard exchange funds in my portfolio, or at least one of them for the most part. But I do know they don't have many EU options for US based ETFs. So like VGT and VUG are going to be the tougher ones to find an equivalent. Let's see. Have you seen Vanguard is going to introduce monthly fees? What?
Yeah, it's like a flat fee. I think it's like £4 a month. Because they're saying that because it's more expensive for them to have customers, investors investing into individually rather than following something that they do themselves.
Really? Wow.
Yeah. So I've been looking at that, which is really not good.
Yeah. That's ridiculous. That's the one thing about the US is, our investment options are definitely an improvement, especially when it comes to like the funds that we can invest in based on the US economy. Because that was one thing that Big Mac did mention. He had a fund that was the world, what was it, international something, and it tracked the markets of emerging markets in different sections of the world. And just historically speaking, the US economy has steamrolled any other emerging market, even China, um, when it comes to investments or just our overall stock market pricing. And so I do think not exposing into international stocks is probably your best option, especially with someone as young as him. You do, and even myself, we're at that age where I don't think international funds are very important. Although they're good for diversification, I think down the line, long term, if you're heading towards retirement, maybe in your 40s or plus, you can start introducing the international exposure because it's going to help diversify and maintain your capital. But outside of that, it's very, very important to just focus on growth when you're starting out, especially those lower capital people that you just want to focus on growth. Because if you look at something like, let's pull up the actual fund that he showed me here, if I can find it. I don't know if I have the symbol for it. It was like Wisdom Tree Global. I can maybe look that up. It's not going to come up here. Nope. I don't have the ticker symbol for it, but which is fine. I just wanted to pull up and give it an example of how that matches up against something like the S&P 500. GGRG, he said. Is it even going to be here? Nope. This one is not the correct one. Oh, here we go. So yeah, when you look at something like this, you're looking at the global, which obviously worldwide we had a huge, huge run in the markets. But look at the 13.88% return and compare that to something like the S&P, which over doubled that in the last year. So definitely important to kind of, limit international exposure while you're younger and looking for more growth periods. And then I do just want to briefly go over some of his other picks that he had. So one of them being EQGB. So this one here, he mentions is the Invesco EQQQ. I'm not quite sure though why it's EQGB because he should be able, so it should be this one here. But he should be able to invest in EQQQ for a lot of you. Let me make sure this is the right one. Yes, it looks like it. So QQQ is another tech-based ETF. So sometimes if you don't want to double dip into VGT and EQQQ, that's perfectly fine. These are obviously the US ones that I'm naming here. I have VGT and QQQ in my portfolio because they're both aggressive in the tech sector, which has just historically shown much greater growth than any other sector. But from a diversification standpoint, once again, if you want to be more diversified, you can expand into other sectors like healthcare, energy, um, and try and limit your exposure to tech only. But the thing about QQQ is it's much more aggressive than the S&P 500, so I typically allocate less of my capital towards something like it. But as you can see, so year to date, we're sitting at about 28% with QQQ, and the S&P is obviously at 27. And then, yeah, I'll get to questions in a second too in chat. But one thing to keep in mind is the S&P over a 5-year period is up about 90%. But then look at something like QQQ over that 5-year period, you're looking at about 150%. So significantly more aggressive, but a super, super strong fund. QQQ is a huge, huge, very common one, but it's just leveraged into that tech sector a little bit more. It's definitely more aggressive, but fantastic returns overall. I mean, 150% in 5 years. You can do the math there. If I can even do the math in my head right now, what is that? 30% a year roughly, which is obviously significant. You're looking at obviously a great period in the markets too. Let's not neglect that. This has been a fantastic period for the last 5 years. But us as day traders, to make 30% a year is fantastic. So imagine a set and forget fund that can kind of be on the side of that as an investment. It's a great, great option. So EQQQ, if you can find that with your brokerage, Big Mac, I think that would be, I was calling Big Mac and I second guess myself because we gave him that nickname years ago, but EQQQ is a good option if you can find it. If not, I think the one that you mentioned was just the one on the London Exchange, so perfectly fine as well. I just wasn't sure what that EQGB or whatever it was. So let me read some questions here. Given that the S&P 500 is all around high, for someone looking to start, you recommend dollar cost averaging. So, well, definitely, first thing I'll say is dollar cost average, definitely. And the reason being is I do agree the S&P 500 is very, very high at the moment. But I do think for someone who's starting investing, number one rule is just get yourself into the markets. It doesn't have to be a lump sum if you don't want, but the more the better, in my opinion, because it's giving you that head start regardless of timing on price. Because one thing that's very, very common is people will say, "Oh, I want to wait for that pullback." Let's say they were thinking about investing here back in October of 2023 and they told themselves, "Oh, I want to wait for that pullback," you would be, left in the dust and left sitting out on one of the greatest runs in stock market history. And it's very, very common. We see it in real estate too. People all the time are like, "Oh, I gotta wait for pricing or housing prices or interest rates to drop before I go and buy property." Those people are 10 years, they're left behind. They forgot about real estate. They're in their 9 to 5 job. They got kids, responsibilities now. Don't let the time pass you by. My honest advice would be start with the S&P 500 only. You don't have to build some crazy complex portfolio, and it would be, let's say you had $1,000. Let's say you even had $100. If you had $100 to invest, I would say put 50 in the market now. It could be now, it could be tomorrow, it could be the next week, but time is key here. And then the other 50, go and dollar cost average that. Maybe put 10 per month. And obviously that applies to any amount of money we're talking about here. If you have $1,000, $100 a month, start with 500 just to get yourself into the markets and then working on dollar cost averaging, and just continue to do that. I think, in my opinion, one of the strongest things someone can do is set automated investments. A lot of funds, what they'll let you do is if you set up a portfolio with certain allocation, let's say 20%, 20%, 25%, 25%, and have it towards your different ETFs, just splitting it up. Having an automated investment, let's say $500 a month, and just having that split automatically between your different funds, super, super valuable. Some people hold off on investing. They don't keep up with it. They don't put as much as they wanted to by the end of the year. So I definitely think that's a huge, huge plus. But if you're looking to get started, start now. There's no better time than right now. And just work on dollar cost averaging as time goes on. You can see if you invested at the start of each month here, You'd be getting in here, you'd be getting in here, 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 here. So it's like all of this is going to help you capitalize on that upward momentum while not missing out on time as, price continues to go on and rally like it has. That's another thing too, is like being able to withstand those high periods and low periods. Because for example, price opened here back in August, and it instantly dropped and spiked very low, and people were starting to freak out. Your money would have dropped a decent amount significantly, and then by the end of the month, it finished in the green, and you would be up on capital. So being able to withstand that kind of volatility too is important, and just understand that long term view. I mean, when you back out and look at this chart, there's no question about it. You're seeing this clear bullish trend, and the U.S. economy will continue in the next 100 years to do the same thing. So it is something important to just try and get in as quick as possible. And then I see the question: do I invest in crypto? So I do. I've had a crypto portfolio for a long time now, maybe like 4 or 5 years. But I've taken like partials and profits at certain areas because crypto being a lot more volatile. Um, for example, Bitcoin. Let me pull up a Bitcoin chart here. So I had a Bitcoin chart, and I got in Bitcoin around the 20K level. It was like right about here, just because I had limit orders expecting for price to get into this area, and then I ended up buying one of these months down here as a lump sum. But I've been dollar cost averaging into it much longer than that, since like 2021 maybe. So I've been all priced in here. I did do a lump sum towards the bottom, and then I just kind of, once we got to the high, I believe I took 50% profit, and have kind of let the other half run. Same kind of idea with Ethereum. I've done the same thing. So price, I got in around, I forget what level it was. It might have been a little lower than this, but I think about 1400. Um, and then same thing, just kind of dollar cost average. If we do end up reaching for highs like this, maybe I'll take some more profits. But there's definitely strategy when it comes to taking profits, because I do think it's super important. Take your profits, dollar cost average in, and continue to do that, because some people who set it and forget it forever, being able to withstand drawdown periods for such a long, extended period of time, for example, someone buying in November 21 and having to withstand massive drawdowns and have no access to their capital for a year, is definitely not something you want to be. You don't want to be that person. So dollar cost averaging is important, but what do you think about dollar cost averaging now? That's what I'm doing, and hold for 10 years. Yeah, I think it's a great option. I honestly, it goes back to my S&P 500 example, just getting yourself exposed to the markets and investments. Timing, I understand everybody wants optimal timing, but it's just not going to happen. Realistically speaking, like, you're better off getting into the markets and then dollar cost averaging as time goes on. Yep, even with crypto, same idea. But yeah, just dollar cost averaging as time goes on. Letting yourself stay in the markets and involved in that investment as long as possible, just to capitalize on it. Because you know how many people, when Bitcoin was this low, were probably telling themselves, "Oh, I want to," or sorry, not when it was this low, when Bitcoin was here and making that recovery from the low. How many people were telling themselves, "Oh yeah, I'll eventually buy. I'll eventually buy." I gotta wait for another dip, wait for another dip, and then we get this secondary wave of very high volume that they get to miss out on now. So some people get nervous that the markets are what they would consider over leveraged right now, or oversaturated, whatever you want to call it. But in my opinion, like, we have no idea if Bitcoin wants to make a recovery in another run, with some high volume, and if you miss out on that, it's going to be the same scenario. People sit out too long. So definitely just dollar cost average. Do your best to keep up with any investment. Sometimes like I said, I even prefer automating it, because it's one of those things where you just set it, forget it, let the investment do its thing, and you don't have to worry about missing out on it, or if you time the markets bad or incorrectly. It's just important to kind of get in and ride the wave out. Ethereum, Bitcoin. I have Chainlink. I have Solana. I don't even have too much education on too many different. I do even have some XRP, um, but I don't have too much education on tons of different crypto. But I've made a killing off of it. So it's one of those things too, where just learning to set and forget years ago when I first set up my portfolio, dollar cost averaging here and there, was able to make a lot of money off of it.
Jay,
So
in terms of your nuclear,
Hmm.
like that. So the basically in for me on my investment platform, these are the only. I'll send them. These are the three tickets, or like obviously one's a share, the other two are ETFs.
Hmm.
But like I don't know, like I haven't done too much.
Wow.
And then is that like yeah,
So what are
like
we looking at? We're looking at June 24. So it's a newer fund for sure. Year to date is obviously fantastic. But I would say it's a little more risky of a fund because it's newer. And the market cap is quite small here. Oh, so that looks like so that's actually a single stock. It's not
yeah,
even.
that's a single stock compared to the ETFs are the two below. But I think the two below are the exact same. It's just one's in pounds instead of dollars.
Mm,
But yeah, NUCI, yeah, I tried to look up on Yahoo Finance, it doesn't come up.
gotcha.
But on this website that on the investment website that I'm on, it has I can see like
So this one comes
literally
up, which this one is obviously a much older fund too. I think if you're between those three, I think this would be your better option. Obviously I don't have data on the other one, but it looks like the only difference is it looks like there isn't much of a difference. Oh, one of them is linked to the pound and the other one is not. So
yeah yeah.
either one, they're going to be roughly the same data anyways. I think this would be your better option of the two. One thing there was another fund. I'd have to look through I have a notes app, and when I listen to podcasts in the car, I just use speech to text, write down a bunch of notes on different things, and then I have ChatGPT go and reorganize those notes every like so often because they get messy. So I gotta find here it is. IDGT was one I haven't done my research yet, but this one, yeah, so very very new. But overall, the reason I've liked this one is because it diversifies a little further, and it is iShares. So I don't know if you guys might have access to this, in the EU.
What is it? ID.
IDGT, yep. But I do like the one that you were showing there. NUCL, is another good option for nuclear energy. But the reason I like this one too is because it does diversify into solar, nuclear. There was a bunch of different real estate even. So real estate for nuclear power plants and solar plants is another huge one. So this kind of diversifies all across the energy sector, which I did like overall. Um, so I am
No, I don't
interested in
have it
this
on
one.
it.
You don't? No, because yeah, that was one thing. It's probably because it's U.S. digital, but
I'm assuming digital infrastructure like what like telecoms.
sort of. So there's also I have a semiconductor in one of my portfolios as well, semiconductor ETF, but this one is specifically focused on solar energy, nuclear energy, real estate for power plants. Like it's basically just an entire energy infrastructure fund, and it diversifies much better than the nuclear only energy. But I do think nuclear is going to be huge within the next 10, 15 years or so. So it's a bit of a long term play, but something I've been interested in. I haven't invested personally yet because, like I said, I have not fully done my research into it to kind of decide or make room for it in my portfolio, but still think it's a great option. Just want to circle back to Big Max too. I will look at some of the other funds. So we already kind of went over EQQQ and VUAG for him, which I both think are good. Um, so he has IITU. So let's take a look at this one. So this one should be essentially the equivalent to VGT. So let's actually pull up VGT here. So VGT year to date, we're looking at about 31%. Over the 5 year, about 168%. So once again, like circling back to what we talked about the tech sector massively outperforming the general markets. 90% gain in 5 years is fantastic, but 168% returns in 5 years. And I've been investing for probably about 5 years. It might be longer. I don't even know how old I am. Yeah, so about 5 years. I've been investing. So it's been one of the best runs in stock market history that I've just been able to capitalize on with a lot of these funds. But 168% in 5 years is just absurd gains. Like that you're on the level of some day traders out there, some hedge funds, just by simply buying, holding long term, set and forget a fund in something like the tech sector. So great return here. I would be surprised to see. Okay, so this worries me for sure. I want to see the age of this fund because sometimes the data on Yahoo Finance can be incorrect here. Let me see if there was another option too that I missed.
I do. I've got IITU on my one.
I think I was in the wrong. I think I clicked on the wrong one. This one looks great overall, though. Once again, another very strong fund over the long term. The tech sector is just unanimous for outpacing the markets overall. It's one of the leading sectors historically. So I do think that's another great option as well. And I don't know if Big Mac. Let me check. Is he still with us? He might be. Yeah, he was in class. So I am 23. Yeah, I forgot how old I was. I was trying to do the math. I started investing at 18, and it's about 5 years.
I just remember you're 2 years above me.
But yeah, so
Yeah.
the tech
This has
sector,
been around for over 10 years, I think.
this fund,
Yeah, IITU, I've got the least data for 10 years. On 698% in 10 years, 265.
said he thought I was way older. I'm not that old. But yeah, I think Big Mac isn't here right now. He'll probably watch a recording, and obviously I'll debrief him. But I think this is a great fund here too. For those of you that are from the EU and don't have access to something like VGT, I think this is a perfect replacement for that. So that's good to know, especially for me, because I am someone who's been trying to find more EU based funds. So when I get students asking me, I can kind of refer them. But this is a fantastic fund here too. So IITU is a great option. One more he had here. This one I'm a little curious about because I've never heard of this. Is this it? QGRP. This doesn't look like the correct one because it's NASDAQ. I want to say.
I do have this. Wisdom Tree US Quality Growth ETF.
Is it this one here? This doesn't look correct.
2547. Yeah, this one's saying. Yeah, it is on here, but it's not been around. It's brand new. It's only been around since this year.
Mm-hmm. Yeah,
So
this one I would be.
May this year.
I would be a little more skeptical on this one. So he was looking for a growth fund, which, well, realistically speaking, with QQQ and VGT, I think he's already off to a great start. I think splitting between VOOV, or sorry, they're not V, but VOOIITU. Sorry, for him it would be VUAG, and then EQQQ is a great start already. However, that portfolio is very tech focused, which is good and bad. It's good if you're looking for that long term growth. It's bad if you're not able to withstand those fluctuations in price. So if you do want a little more structure to the portfolio as well, I would assume they have something like VTI maybe, which is like a total market index. Or like he mentioned before, if you want some international exposure to kind of diversify and help, not have to withstand those large fluctuations in price, that could be a good option as well. But I do think the funds he's talked about, with the exception of I don't like QGRP, it's a very new one. So I'm not too fond of that one. I think that could be replaced with something a little more conservative if he wants, because I know he wanted some international exposure. He mentioned it a few times, which is fine. It's going to be less growth, but I think having EQQQ, IITU, and then VUAG is going to kind of carry the growth of his portfolio, so he can focus on those other funds. But I think that's a pretty good portfolio overall. If you did an allocation between those, I would say more likely than not 40% VUAG, and then leave the remaining 20 into those three other funds I talked about. Whether it be international, EQQQ, or IITU, that'd be a pretty solid setup of a portfolio. Actually, just DMing you right now, Big Mac. I know he's probably not in call anymore. I think he said he was in class. But
hey, what was the fourth one? 40 VUAG, 20 IIT, 20.
And then the fourth one I was saying, he did have some international funds that he was kind of letting me know about. But realistically speaking, I don't have too much international exposure myself. I kind of bet on the US economy. But he had international exposure for like emerging markets. And if that's something he wanted to maintain in his portfolio, I think keeping that while keeping these heavy growth stocks is a good idea, or ETFs is a good idea. So
How much do you allocate to your new?
just 5%. I only have it in one portfolio, and I have about 5% of it in that portfolio. So just kind of typing this out to him real quick, just as like a debrief on his portfolio. I'll have to obviously type more later and break it down for him. But yeah, I only have about 5% towards nuclear energy, but it's because it's more speculative. Um, the rest of that portfolio that I have it in is the very long term one. And then I combined that with, so I have another portfolio that's kind of a little more speculation. I have another one that's just ETFs. Um, and then that one is kind of a mix. It's got ETFs and then a little bit of speculative with that nuclear energy. So all very, very long term. Um, but I do think that's going to be a longer term play. Thank you, Esteban. But I mean, yeah, but
It's a good play when all these big companies want to buy.
I know a lot of these larger companies have already made moves into nuclear energy or mentioned they plan on moving towards nuclear energy. Because one thing historically over the last about 15, 20 years is energy has kind of plateaued as a sector, and I do believe that it's going to be explosive, over the next, with all the AI and new things that we're incorporating. I think over the next 15, 20 years it's going to be massively under leveraged, and we're going to need a lot more energy infrastructure to come into play. And that infrastructure is kind of why I looked into that other fund I talked about. Is just, as much as I think nuclear energy is going to be a huge play, I think the infrastructure around all energy sectors, it's going to be kind of something that's brought up as a whole, as well as semiconductors, which I do have in one of my portfolios as well. But huge goals for those. And then even I have VO and VB being funds that I have. This is right. Yep. So these are even funds that I've been kind of looking at. So this is mid cap and then small cap. VB is the small cap version. But I think mid and small cap stocks we're going to see a huge rally. Hopefully over the course of the next year or two. So it's a little bit of a shorter term play. But this has a lot to do with the cuts in interest rates that the U.S. has been making. And my expectation is that, well, typically in history, when interest rates are cut, mid cap and small cap, for those of you that don't know, it's just companies with a lot less capital than large cap. So their market cap is what it's referring to, which I have no idea where it shows it on. Oh, we're in an ETF, so it's not going to show market cap, but um, it basically means that these are the companies that are a bit undervalued. They don't have as much capital and resources as a large cap company. So large cap, you're going to think of Apple, Microsoft, Google, Facebook. Mid cap, you might not even know the names of the majority of these. But the key here is that when there is cuts in interest rates, it means that companies can borrow a lot more capital and have to pay less of it off because the interest rate is lower. So it gives smaller and these mid-sized companies a lot more leverage to go and grow their business. So it is something that typically in history with those rate cuts, you will see these smaller companies grow a lot quicker than large cap. So I think they're going to kind of catch up and meet up with this massive rally we've seen on large cap stocks in the last 5 years or so. That's a bit of a shorter term play for me, is VO and VB. So we'll see how that goes over the next couple of years. But it's 25% on the year. So VO and VB both definitely lower pace and definitely lower allocation, but I do think we can see some significant growth there in the next few years. Other than that,
I don't think we have those. The
uh,
only thing I can see for mid cap is Rhoda US mid cap.
yeah, I'm not sure how it works over there. So mid
And
and small cap, I haven't even done my
what's
research into the
4% mid cap, the US
uh you're saying percent for returns or
one? Yeah, for the 5 year.
5 year about 60%.
Oh, this one's done 57.
So it likely tracks the same fund, maybe. Because you did mention it was a US one, right? Mid cap.
It says
What's the symbol for it? See if it's on here.
doesn't give a symbol.
Oh, really?
That's literally the name it gives.
Huh. Here it is. That's one thing. Does it let me show holdings? Oh, so it does. Okay. So sector weightings obviously weighted heavily into the tech sector. 3% cash right now. like I mentioned, we probably won't recognize most of the names for some of these. I don't even recognize their top holding, but it is because it's a smaller company. No bond holdings. Year to date, average 5 year. 10% over the average of 5 years is fantastic, though, still. Um, Honestly, it's not a bad fund for mid cap compared to that and small cap. I don't know if you guys, I have no idea what this means on yahoo.com, but yeah, I think that's
Um,
honestly another good fund. It probably, realistically speaking, tracks the same type of funds as VO, because there is a lot of funds that are just trying to match up with the US ones because they're not offered over there. But yeah, it's not a bad option either for a shorter term. Shorter term being the next few years, but obviously in the grand scheme of a portfolio, that's still considered pretty short term. I have some gold as well in another portfolio, but just absolutely ridiculous right now. I've been making a ridiculous amount of money with GLD, but it's just similar to like Bitcoin, similar to the markets overall, just absolutely skyrocketing over the last few years. This is like been one of the craziest years when it comes to investing and being as young as I was starting it. I think that's another thing too, Esteban, is like I wouldn't be hard on yourself for like age and how much you have, is because like one main difference is like I've been investing since I was 18, so I was able to capitalize on the greatest run that the stock market has essentially had in decades. But that doesn't mean that in the next 5 to 10 years we're going to see the same, and it doesn't mean that we're going to see different. We could still see this rally continue another 5 years, and there's no better time to invest than now to kind of capitalize on that if it occurs. So it really is like a time game when it comes to investing. Some people are like, they try to make those short term quick plays, buy, hold for the long term, set and forget, and just dollar cost average, and it's inevitable that over, I think it's actually factual that in a 20-year period, if you invest in the S&P 500, you will not return, and you will not have a negative return, assuming accumulated dividends, and that's adjusted for inflation. So if you hold the S&P 500 for that long, it is a 100% guarantee that you do not lose money. And it just kind of goes to show that long-term play, obviously, that we're trying to make here. Take a look at some setups, but I do want to go over. Jason has sent me some trades, so I want to go over those because he is in the call with us right now. Let me find his server. So, let me pull it over here. I want to make sure I don't lose it. Go. All right, and you guys can see this, right?
Yep.
All right, so let's go overall first is what I want to look at. He mentioned his win rate. This was from before, but he mentioned his win rate was a little bit low on this one. So 26.6% win rate. I will say, so over 200 trades, it looks like. And you can see we kind of, realistically speaking, just ended at about a break-even level. Max R3, just making sure everything looks good in this respect. So February to December, so about a year's period here, a little under. And I just want to take a look at some of this. So average win, average duration, all looks good to me. 2 consecutive wins. So I will say that's fairly low, which likely has to do with that win rate. So we'll take a look at the setups in a second. Worst loss 1%. So everything here looks good, pretty standard to me. 5 consecutive losses. That's another thing I want to point out here too. Even with a lower end win rate, we can definitely give some tips here to bring that win rate up. But even with that lower end win rate, like a 5 consecutive losing streak is perfectly viable. I feel like this unanimously is a number, maybe 4 to 5, where a lot of students start ending up in my DMs or messaging me and they're worried about their edge and plan is about 5 trades. And I like, even me, like I just took a 4 trade losing streak last month, and you could see based on the equity curve, like 2 wins in a row, not including break evens, and already back up and above that 4 trade losing streak where I was before. Like it is something that is tough. I understand mentally, like losing 4 in a row, people are afraid to take that 5th one. But you could see if I sat out of this trade because I was afraid of the previous 4, I would have just missed out on making back more than half of that in profit. So it is very, very important, but it's super, super normal for 5 trade losing streaks, 4 trade losing streaks. So let's take a look at some of the data here. Let me Let me some of these. So that was 2023 analytics. I want to make sure I don't double dip on any of the trades here. We'll start bottom up because I know this is most recent. So analytics on this pair as well, just briefly want to look at. So 28% win rate, 9 trades of data we're going to look at here. So first thing I will say, like off the bat here, is just because something follows the rules definitely doesn't mean that you want to go and take it when price is sideways like this. So a huge rule, it's kind of a soft rule, but for me, if I see prices working in a range like this, definitely avoid these sideways ranges. It'll save you so much of a headache, and in this alone will drastically increase that win rate, just avoiding sideways price action. Because at the end of the day, like there's no real volume introduced here, despite the fair value gap in that most recent leg of price. When there's a range like this, price grabs that high of that range and all of the orders in it. 99 out of 100 times, it's now going to go and target the low because that's where the most orders rest. So when you think of the market just strictly from a liquidity and an order standpoint, all consolidation means is that everybody from, we're looking at the 19th of whatever month, this might be December, to oh no, this is multiple, but regardless, this time frame that we're looking at here, whether it's 2 months, um, everybody that wanted to place an order on pound NZD within 2 whole months is going to be within this low and within this high of price action, meaning that all that rests in here is buy and sell orders. And then when the institutions grab the top or where the most sell orders rest, they're now going to go and target the majority of those opposite orders. So I really try to avoid ranging price action. It's just I found so many more losses than not inside of it. This one's I don't think is a bad trade. It's a bit ugly with the high here. So one thing I did briefly brush over these before the call, and I would say one thing to focus on is those very high and impulsive breaks of low or highs, but should have been a loss without. Okay, so this is just his own personal note saying that if it hit didn't use break even, it would have been a loss. But yeah, I think this is a decent trade overall. I like the liquidity sweep that you drew out here. I like the fair value gap. The high is definitely a bit ugly. We didn't really make any impulsive move out of there, but no problem there. I think this is a great setup too. No problem with this. I think if you do see a clear visible trend too, and the high is not very impulsive, it's sometimes better to sit out, but that's just, nitpicking details that might help your win rate a little bit. But I think marginally, if you're going to really focus on bringing that win rate from 26 to say 30 to 35, start with the bigger things. And those bigger things are going to be like focusing on not taking trades in ranges, and then focusing on impulsive highs or lows. And then if you want like trying to be a little bit more trend friendly, can definitely help as well. If you see a clear bullish trend, maybe trying to avoid shorting if the position isn't the cleanest. This one I think is a good setup as well. Nothing wrong with that one there. Good loss. This one I would say is a pretty good loss as well, but once again, it kind of does resort back to that trend friendly thing that we talked about. This low is not very impulsive. So like if I saw this and it was against price action, let's take a look at AUD JPY. So you can see on AUD JPY, we grabbed a low, we're against the trend here, but look how impulsive we grabbed this low with 2 massive candles and then shot right back out of it, creating that break of structure with these 2 large candles as well. So I do know a lot of people were able to capitalize on that one. And it's, once again, focusing on that impulsiveness, that very strong volume grabbing liquidity, and then super strong volume out. Now, compare that to something like this, where price kind of worked its way below that low, kind of worked its way back out, and then did have some volume towards the end, but you got to really focus on where your stop loss is resting and ask yourself if that's a very high volume place where institutions were likely involved. So could be a similar scenario here, even where there wasn't a very clear liquidity sweep, but your low is very low volume here as well. We're seeing more of a consolidation range versus something like this. For example, this was a winning trade, and look at this candle here, how large of an impulsive candle that is, followed by this large and impulsive movement out. The only thing that does create the sweep here is just this little wick. So you're seeing an impulsive grab of those orders, impulsive movement out, and then price does end up respecting that area in the longer term. Even kind of something you're seeing here as well with this high volume out, high volume, or high volume in, high volume out, and then price does work its way back up to respect that again as well. So volume is definitely key when you're looking at your stop loss. You want to make sure you're at a solid level. And this would be another example of, not having the best area for stop loss. So I think that's one of the first things I would mention, is focusing on that high volume stop loss area, having very good impulsive movement where your stop loss is resting. And I think that would definitely help your win rate marginally here. Because you can see we're kind of just very low volume sideways price action, and then it moves downward. In most cases, this is just where a lot of liquidity rests, so price is going to go and try and attack that liquidity. And you can even see right when we grabbed it here how high volume we grabbed the orders, and then most likely it could have even ran to your TP after this, if I had to guess. Otherwise, though, not too bad. I do like this one. Once again, look at the high volume movement. These two very large candles grab the liquidity, and then all this volume with multiple fair value gaps to the low. So we're looking at those high volume areas that seem to be working better for you. So it would be something I would focus on a little bit more. Just want to make sure I don't miss any questions here. Yeah, so what I sent you is the allocation. It's just a brief setup of the allocation. You can obviously adjust it as you want, but I do recommend having a little bit more in VOO just because it's the more standard fund compared to some of those more aggressive ones. And then I did mention you can keep some international exposure if you want, only because that the tech, you are in two tech sectors there in VOO or VUAG, sorry, is a tech focused ETF as well. So kind of being overly focused on tech, you can have international exposure or something you would prefer for more diversification. So like that last 20% of the portfolio could be any type of diversified fund or even single pick stocks if you like. If there's any stocks out there that you're interested in, Tesla, Microsoft, Apple, whatever it may be, you could even do that for a smaller percent of that portfolio. Let's take a look at Euro NZD here. 50% win rate, but only a total of 5 trades here. So we'll take a look at some of these. This one, I see nothing wrong with it. I think it's a great setup. We're seeing a bit more of a bullish price action. It's slightly sideways here, I will say, but I'm not going to be too nitpicky about that because I like the low that we swept and I like the high that we broke. So that's a good trade overall. This one I might be, a little iffy about, despite it being a winner. You could see where we are just very, very sideways here. I do think the only reason I like this one, as well as that previous one, is we're seeing. Can I draw on this? I always use this. I don't know if there's an easier way to draw, but I do like the fact that we're seeing a higher high, higher low, higher high. We barely took that low, so I'm going to consider that equals, but we did break the overall high here, which is the only reason I think this would still be a nice setup to take. I think you marked it out well too. So the fact we are taking higher highs is good. If price was just continuously staying within this range, I see people trying to take trades in here where there's no clear highs or lows broken, and it definitely hurts that win rate. I think both of those are good trades so far. This one here, another good one. I mean, I like the low that we're taking here. I like that we're in that bullish trend and still breaking structure higher. I will say the low here is definitely a bit lower volume as well. Worked out in this case, but you can see it did not work out in this case. You got the break even off here, which is good, but once again, like if price is very low volume like this and just low and slow, I try to avoid these setups. I find them to be less probable. Liquidity sweep is quite aggressive. I think you meant like aggressive as in not too clear here, which I think I would agree with as well. But you managed to get the break even, so not bad there. And then I would say this is a good setup for me. I like the consolidation here. We still have that strong bearish candle followed by the very heavy bullish candle, so I think that's a solid setup. Nothing wrong with that one. Take a drink of water here. I'm starting to lose my voice. Tesla's been ridiculous at the moment. All right, let me pull up OBS, just make sure it's still going. All right. Oh, I didn't realize we were running out of time here. So I guess I can try to wrap it up just based on what I've seen. I will admit I did do a bunch of analysis before this just to kind of briefly go through them, but I wanted to go over them in the webinar. So I think if I had some of the comments, I'm not going to type right now. I can do it after the webinar because my keyboard's ridiculously loud. But I think some of the main things would be focusing on those high volume highs or lows in price action. Focusing on clearer ranges too is another thing I noticed. So for example, there is a sweep here and a break of structure, but you got to understand how much price is developed after that and not holding trades as long as this. I find that you want to focus on those more aggressive or ranges that are currently present. So like USD CAD, this was my most recent break of structure, most recent price action. Euro AUD, same idea. And then even USD JPY, same idea, most recent price action that swept liquidity, broke structure, whatever you want to call it. Pound CAD even. So following these higher highs and higher lows, same idea, versus something like this where price was broken downward. We came back up. We worked our way back into the range, came back down, never invalidated that low. I just think holding this small of a range in comparison to the trade is not the cleanest here. So this is the 50% of the fib. Sometimes a soft rule I have is if this is beyond the break of structure, I prefer not to take those trades because to me it just tells me price ran way too far from my entry and I might have missed that bearish move that we expect. So other than that, though, it's focusing on those impulsive highs, strong sweeps on liquidity, um, focusing on cleaner ranges. You know, that 50% rule can maybe be something that you implement. So cleaner ranges being, yeah, so 0% win rate on this pair, but cleaner ranges and then also avoiding consolidation. So when price is moving sideways, like the trades we looked at here, definitely wanting to avoid these types of setups. They're going to lower your win rate significantly trying to take setups in ranges like this. So avoid those the best you can. Focus on those high volume highs or lows as well, like we talked about here. Very slow, low, and slow working its way in and out of there. So not the best setup to be taking compared to, we looked at this one where very quick and impulsive bullish move, very quick and impulsive bearish move, and this one ends up getting respected too. So focusing on that volume as well can be very helpful. I think overall too, you're going to improve naturally from your testing. The more you test, the more you'll find different nuances that help your edge. So don't be too hard on yourself either. If it's like, you know, you're somewhat newer to using FX replay, testing in realistic market conditions as well. Because I do think a lot of these setups are really solid. The majority is just like I said, focusing on that strong high volume low or high, taking your trades from those areas. I do think that's all though. I like a lot of these trades too. A lot of the winners, like there's nothing wrong with the winners, which in my opinion is very important as well. If some people have some odd looking winners, it definitely takes away from that edge more than some odd looking losers. But I will say, like another one like this, I definitely think it's a bit sideways for my preference here. We don't really have a gauge on where price is going. Um, but yeah, I mean, any other comments you have for me? I know I always lose my voice. It's because I talk fast too. Like I talk fast and for an hour straight, and I'm losing my voice, and I barely drink water. Are there any questions you guys have for me before I wrap it up? And obviously, I'll do a for Jason. I'll go into your server after and start like typing out some of the tips I gave. But I think that might be all for the webinar here because we're running out of time. Thoughts on CAD Chef? Let's see. The bearish move, I'm assuming here. This is my most recent loss on CAD
Yeah.
Chef.
I don't know. Like, it's not too impulsive upwards, but
I I agree. I'm not really seeing. I mean, there's some fair value gaps within here, but it isn't something that I personally saw. But I don't think it's a bad setup. If you want to take this one, I think it would be valid.
no,
Um,
I'm done with trading since it's the last day. But
that was one of the reasons why I actually wrote this in my loss for my CAD Chef was just the price action here, the range we're working within wasn't the cleanest.
yeah, I also like how we swept that low on the higher time frame.
Yeah, but not a bad setup there. Any other setups? Pound Chef. Let's see what we're looking at here. I'm assuming the bullish move here, also not a bad one. I like the fair value gaps near entry here. So if you're looking at something like this, break the structure up. I think this one's pretty solid. I like the sweep here, and I like the low to the high. The high is a bit ugly, I will say, but I like the fair value gaps near entry as well. So something like this could be a pretty solid setup. Like I said, I'm done for the year too. There's even some equal highs resting here at the top. So I do think this is a pretty solid setup, honestly. For those of you that are still trying to trade or finish out the year. I honestly don't typically take breaks. When I was swing trading last year, I did fantastic even during the holidays. I just set and forget my orders and did really, really good. So maybe I will find myself continuing to trade into the year, but any other questions? Oh, baby. All right. Well, I think that's about time to wrap it up too for the webinar. So I will see you guys next week. Any other questions, of course, just DM me. And yeah, thank you all for joining.
Take care, Jay. Thanks for the session.
Yeah, you too, man. See you.